answer for Dunham, who's averaging close to 12 yards a carry this half.
Green, 67! Green, 67!
Oh, what a hit on Dunham by Switowski.
That was one of my favorite movies growing up, The Longest Yard. I'm Andrew Labbad from Wheelhouse Capital Management. At a young age, I played contact sports, hockey, football being two of them. And I was told from my coach that by wearing shoulder pads and a helmet, I'd be safe from serious injury. After years of study, it's now very well known that there can be devastating long-term consequences of being hit over 1,000 times in the head. Our brains, our skulls were just not made for that type of impact. And so I'm using that as a segue into fixed income because over the last 30 years, interest rates have really gone one way lower. So your traditional long-only fixed income strategy has generally produced great returns, stable, positive returns. However, we've gone from, call it 10% to 0% in 2020, and we've taken a 180 and gone up 400 basis points in less than a year. And so that's had huge impacts on fixed income portfolios, but also on other asset classes. And so 30 years of interest rates moving lower, has that given your average investor a false sense of security on that type of investment? And so this is a great table that shows the monthly returns of a traditional fixed income index in Canada over 20 years. The largest monthly negative return was just over 2%, and it happened sporadically over 20 years. However, in 2022, we've had multiple months of returns down over 2%. And so in that case, most fixed income benchmarks year to date are down 11 to 14%. 10-year treasuries, which is a good bellwether of fixed income, is having its worst performance in over 100 years as of the third quarter of this year. A traditional balanced portfolio, your bellwether diversified portfolio for your average investor of 60-40 equities fixed income, is having its second worst year on record in the span of 100 years looking back, with the worst being in 1987. And so I don't think your average investor has signed up for that type of loss. Many of investors are risk averse. The reason why they're in fixed income is because they don't like losing money. And so I think having alternative investments in your portfolio is a great solution that is truly uncorrelated with other risk assets. Here's a great example of our two signature solutions for our clients, our Lions Bay North American Long Short Equity Fund and our Amplus Credit Income Fund. And we're comparing it to the traditional balanced portfolio. And so Amplus was launched in July 2020. So we're taking $100,000 that would have been invested July 2020. And over the span of 2.5 years, your investment would have grown 75 to 80% in our two hedged solutions, whereas your balanced portfolio would have been flat during that same time frame. And so we spoke about this earlier, interest rates. Looking back 14 years, interest rates have really gone one way lower, but in just under 1 year, interest rates have taken a sharp turn higher, going from virtually zero to now 3.5%, 4%. And the bigger question now is, can they rise further from here? Essentially making you lose more money on your traditional long-only fixed income portfolio. And the answer is yes. If you look back 30 years, we aren't nowhere close to the interest rates that we've seen in the 1990s. And so that could have devastating consequences on your portfolio if we were to see interest rates rise further from here. The next two slides are on inflation, just to give you a quick glimpse of where we're at and where we can go from here. So inflation obviously is at multi-decade highs in the US. The blue line is your core CPI number that the Fed is carefully looking at, and we still haven't reached a ceiling on our core CPI number. So you would think that central banks, specifically the Fed in this case, has more wood to chop has to increase rates further from here. The same could be said in Canada. Have we really reached a ceiling? Are we going to tilt and ease too quickly? And so you got to remember, their targets are 2.5% annual inflation. So there is still a lot of wood to chop, as I truly believe. And so interest rates can definitely go higher from here. Credit versus interest rates. So when you look at a corporate bond, there's two components to a corporate bond: the risk-free rate and the risk of default. The risk of default being the credit spread, the additional yield that an investor would want to receive to own a corporate bond with the risk of defaulting. And so in times of distress, the investor would want to get paid a higher premium to own a corporate bond. And in times of monetary easing, there's a lower risk of default for many of these companies. And so you wouldn't require as much of a premium to own the corporate debt. And so we stripped both components out of a bond. We took the risk-free rate, being on the blue line, a 5-year treasury. We use the 5-year treasury because an index is, fixed income indices are generally 6 to 7 years. And the gold line being your risk of default or your credit spread. And both lines are essentially weekly moves in yield changes over the span of 8 years. And you'll notice that the volatility of your interest rate move is significantly higher than your credit spread move. And so we want to strip out the more volatile component of fixed income, being the risk-free rate, underlying interest rate risk. And so what do? We invest generally in corporate debt, high quality corporate debt, 95% of which over the last year has been investment grade. The other remaining is publicly traded high yield debt. We strip out the interest rate risk, and that's allowed us to produce stable positive returns during that time frame. Our largest negative drawdown was down 53 basis points. Again, we prefer public markets over private markets because there's more transparency, much better liquidity, the ability of triggering capital gains versus only interest income. And again, there's a lot of nuance in private securities versus public securities. One thing to keep in mind with fixed income in general, it is an over-the-counter product. Therefore, having great relationships with the dealer community is critical in terms of getting the bonds that you find cheap, getting great trade execution, and getting overall good liquidity. And so if we were to look at Amplus Credit Income Fund alone, we're up about 36% since inception of the fund, whereas most benchmarks, fixed income benchmarks, are down during that same time frame. This is a very simple example of how we neutralize the interest rate exposure. So in this example, you'll notice we buy a TELUS 4-year bond. We'll short a similar duration, a 4-year treasury. We take out the interest rate component of it, and we're essentially only investing in the credit risk profile of that company, being TELUS. We do apply leverage to it, and because we do so, we're generally investing in shorter dated securities with much better visibility of future cash flow than investing in, say, a 30-year bond. Credit spreads. So we showed you a chart earlier of weekly changes in credit spread movement. This is the same chart. And from a historical perspective, we are at the wider end of the range. Many bonds are in fact trading much cheaper today than they were at pandemic lows, excluding maybe 3 to 5 trading days. But from an all-in yield perspective and from a price perspective, the valuations to own this debt now are significantly better. In fact, we used an analogy in our first ever commentary, speaking of which a 30-year treasury or a 30-year corporate bond, if it were to have a 100 basis point move higher in interest rates, that would actually produce a 15% loss on your portfolio. And so we've gone from essentially a 50 basis point all-in yield on 30-year treasuries to 3.5% in just over a year. Using that context right now, any bonds issued from March 2020 to December 2021 have very low coupons attached to them, but yields are significantly higher. So we took a subset of the bonds issued, over that time frame, with maturities of 5 years or more remaining. So that would leave us with 227 investment grade securities. Of that, 83% of them, or 189 of them, are trading below $87, 84 of them are trading below $80, and 44 of them are trading below $70. In terms of current positioning for Amplus, just quickly, we've definitely moved the portfolio into a more liquid, higher quality concentration. We have less concentration in name-specific issuers, cleaner balance sheets, debt-friendly companies, companies that are looking to reduce debt aggressively. We spoke about that with Suncor and Cenovus multiple times in our newsletters and on social media. And I would say the only dramatic change that we've done over the last 2 years that we currently have on is more interest rate exposure, simply because yields are the highest they've been in over 10 years, but we're still significantly lower than benchmarks. Benchmarks are about 6 to 7 years of duration. We have about 1.7 years of duration in our portfolio. So to conclude, Amplus Credit Income Fund is the perfect solution for everyone's portfolio.